Welcome back to the first episode of Inside Options. We've been given a very colourful lesson on the history of how options came about with my co-host James Boardman from the Equity Derivatives Division at the JSE. Now it's time to talk analogies, bringing us right back into this day and age. James, how analogous can we be here?
There are a lot of very, very nice analogies that you can look at in terms of understanding. So let's look at some sort of analogies of options. A call option is the right to buy an underlying instrument at or before a certain date in the future. So let's look at the example of if you're trying to buy a house at a certain time in the future. For example, sort of you're waiting for your Christmas bonus because you need that chunk of cash to add to your deposit for when you take out your home loan. You're worried the housing market's pretty strong. You're worried the price might go up and sort of get a bit beyond you, and you know the house you want. So what you could do is you could use an option. So you could go up to the guy who's selling the house and you could say, right, I would like the option to buy this house in December at the current price of, say, R1,000,000, and I will pay you a fee of 50,000 Rand to keep the house at R1,000,000 price for me if I want to buy it in December. If I don't decide to buy it, you just get to keep the 50,000 Rand and you get paid that premium for taking that risk. So the great thing about that is that even if there were other buyers willing to pay 1.3 million Rand for the house come December, because of your option, you've locked in that price. If the houses were selling, sort of the same sort of houses were selling at 800,000 Rand, you could then say, right, I've walked away from it, and all you've lost is that premium of that 50,000 Rand.
So in a way, is it similar to sort of paying a deposit or a down payment?
Yes, yeah. It's sort of a down payment that you get back. Yeah. You know, it's and that's a vital point, that you do put it down and you get that option to buy or not to buy. It's not a binding agreement. You know, a futures contract is a binding agreement on both parties. The only way to get out is to find someone else to buy it off you. So then you sell that position on. Whereas in an option, if the position is not favorable at expiry, you can just walk away.
All right. Okay. So is it time now to look at a put option?
Yeah, no, absolutely. So let's bring it a little bit closer to markets and financial markets, because that's largely what this show is about. So if you own shares in a big pharmaceutical company that is awaiting the news of a clinical study, they're hoping for approval from the government regulators for a new medicine for treating high blood pressure. So you currently own the stock and you think the stock is a great company, you think it's going to go up, but you're worried it could take quite a severe dip, and you want that sort of protection from that downside. So what you could do is buy a put option on the stock at its current market price, let's say sort of 80 Rand for 6 Rand, and thus limit your potential downside and keep your upside if the results are favorable. So the key thing about that is you're protecting yourself from the downside by buying the put, but if the stock rockets up to 140 Rand immediately on the news, then you're actually protected, you're still in your position, so you haven't missed out on it. If you sold and tried to get back in, it could run away from you.
All right, so it seems that there are advantages on all sides here. Why is there this perception that they're so tricky?
They are pretty complicated, but when you break them down into little pieces and you watch this show, you will have a far, far better understanding of these tools. So you can see that options can be used as a tool to reduce risk and manage uncertainty. They can also be used as a very useful tool for speculating or investing into financial markets. So many of the world's most successful traders use options on a regular basis due to their amazing usefulness in many market situations. I mean, if you've read sort of books like The Big Short, the great book about the financial crisis, very fun book, I highly recommend it to all the viewers. The guys there who made all the money, they were using options. They were protected at the top of a bubble, and they bought long-term put options, and they profited massively. So a very, very useful financial tool to have at your disposal.
Let's bring it back into currencies. Can we look at an example?
Yeah, so in currencies, we've got a recently very, very strong growth in our on-exchange currency derivatives market. We've had a fantastic year so far with volatility in the Rand and all sorts of people coming to come and hedge their expiries. We've also introduced a new contract called the Any Day Expiry, so it's sort of very flexible, brings you a lot of the flexibility of over-the-counter OTC trading, and we've had some huge trades in that. So if you wanted to hedge a currency, let's say you were an importer, you had a big shipment due in 6 to 8 months, you wanted to lock in a current price. The Rand's quite strong right now, you're worried if it slides back, the goods you're importing will be too expensive, and you'll lose out on this great opportunity. So what you can do is you can either buy Rand's futures contracts, or you could lock in a price by buying some call options. So what that would do is you'd buy at 6 Rand, I think it's about 6 Rand 80, 6 Rand 90 at the moment, and you'd buy a sort of a 7 Rand, you'd lock in. If it went above 7 Rand, you'd be protected. But if the price fell to 640, you would be able to take advantage of that and import your goods far cheaper. So it's actually really very useful.
All right. Okay.
Because you don't have that lopsided, you've got that lopsided obligation, whereas if the currency, the rand, suddenly gets much stronger, as an importer, you can still benefit from that. With a futures contract, you can't really benefit from that. You need to exit the futures position, you lose that upside, you've locked in a price of 7 Rand. But because futures are more liquid, more well understood, it may often be a better decision to use a future to hedge.
All right, James, we're going to pick up on this again next time round because I think we run out of time. But thanks for joining us and for taking our viewers through the very interesting history and some of the analogies.
Cool. That's a pleasure.
What are we going to be looking at next week, just briefly?
Next week, we will be looking at some more interesting examples of how to invest in options, how to choose a strike price, looking at where your break-even points are so you can understand where the price point has to pass for you to actually be profitable on a trade. We'll also be looking at a very brief introduction to payoff diagrams. It's a fascinating visual representation of what an option will do to your financial portfolio.
Great, lots to look forward to then.
Absolutely.
Great. So obviously fascinating world out there, and we'll be checking out more stories from the world of investing next week. So remember, you can find the show on the website, and we'll see you again soon for more on how to become a successful options trader. From me, Jane VG, and James Boardman, thanks for joining us. See you next time.